On May 11, Singapore stocks took a dip, while Wall Street remained mostly on the up and up. The reason for the rise in the US was thanks to a pleasant surprise. Inflation figures were lower than expected. Unfortunately, the same could not be said for Singapore. Hello everyone, and welcome back to our channel. In this video, we're going to talk about one of the most debated topics in finance, buying stocks during a market crash. We'll discuss whether investing during a recession is a smart move, and provide some tips that can help you make informed decisions when investing in the stock market. If you're interested in finance, entrepreneurship, and the stock market, then this video is for you. Don't forget to like and share this video with your friends and family, and hit the subscribe button to stay up to date with our latest content. Let's get started. According to Kelvin Wang, a stock market expert from the Asia-Pacific region, there is a chance that the people who set interest rates in the US might not charge as much as they originally planned. This is because the cost of things people buy in the US rose less than anticipated. However, he cautioned that prices might rise again because some prices that are typically slow to change are still high. Additionally, there is a risk that food prices around the world could increase too. Before we dive deeper, let's define what a market crash is. A market crash is a sudden, severe drop in stock prices. It usually occurs due to investor panic, economic turmoil, or geopolitical events. A market crash can be short-lived or long-lasting, depending on the underlying factors that cause it. Some examples of market crashes in recent history include the 2008 financial crisis, the dot-com bubble burst of 2000, and the stock market crash of 1929. Today's sponsor is LearnSimi. LearnSimi offers SSG-approved courses on a variety of topics, including filmmaking, drone flying, food safety, and smartphone photography. If you're interested in improving your skills, head over to learnsimi.com and enroll in a course today. Now, let's get to the most crucial question: should you invest during a market crash? The answer is not straightforward. Investing during a market crash can be a smart move, but only if you do it right. It's important to remember that the stock market is unpredictable, and even the most seasoned investors can't predict the future. So, before investing, it's crucial to conduct thorough research and understand the risks involved. Don't expect to make a quick profit, and be prepared to hold your investments for several years. The stock market is cyclical, and it's essential to have a long-term investment horizon to weather the ups and downs. The stock market is volatile, and prices can fluctuate rapidly. Investing during a market crash can be a smart move, but it requires a thorough understanding of the market, patience, and a long-term perspective. It's important to note that investing during a market crash can be risky, and it's crucial to do thorough research and understand the risks involved before making any investment decisions. But ultimately, it's up to each of you to weigh the potential rewards and risks and make an informed decision that aligns with your financial goals and risk tolerance. And that concludes our video for today. We hope you found this information helpful and informative. Have you invested before? What strategies have worked for you? We love to hear your experiences and insights. And if you have any questions or topics you'd like us to cover in future videos, let us know in the comments. Your feedback is always appreciated. Don't forget to like this video if you found it useful, and subscribe to our channel for more videos on finance, business, and entrepreneurship. And if you're looking to improve your filmmaking, drone flying, food safety, or smartphone photography skills, make sure to check out our sponsor, learnsimi.com, for SSG-approved courses. The link is in the description below. Thank you for watching, and we'll see you in the next video.